this paragraph formalizes their call for 3,500. And then it tells you the three demand cohorts that they've quantified better than anyone else. They've quantified why the demand will increase. And then they also touch on the uncertainties that could raise the price, although they don't say it, or lower the price.
Welcome to the Morning Markets and Metals with Vince Lanci, where each morning Vince brings you the financial and precious metals news to get you ready for your day. And now, here's Vince.
Hello, everyone. This is the Bank of America Gold Report walkthrough. There's a lot in here. And from time to time, Bank of America will put out very large reports, and they have a lot of good information, and they're well written, but they're formatted in a way that may hinder your ability to absorb right away. So we're going to try and help you with that. We also think there's some very interesting new concepts put in here about quantifying gold that should be discussed. There's also one by Goldman Sachs that discusses similar but not the same quantification techniques. And we want to go through that here so you get the most out of this. So the purpose, right, is threefold. Number one, to give you some context, in no particular order, to give you some context on this report with regards to other reports. So you can read it and say, hey, this makes sense in context of that. The second is to clarify implications, extract and elaborate on them in a way that's going to help you get the most out of this report. And the third is to give you some third order commentary, like a trader on a desk would who reads these for a living. So let's start with this. The report comes out March 25th. Bank of America raises their price target to 3,500, period. That's the headline. Forget all these other headlines. That's it. And they're going to raise it again if they have to. That's my headline. They're going to raise it again soon, I think. But we'll see. Okay. So historical context. This report comes out on March 25th. Goldman Sachs put a report out similarly. In combination, these twin reports, twin towers, it's like they're the twin towers of reports right now. And I say that because they're getting incredibly frank in their analysis that they're sharing here. It's almost like they're trying to catch up because more news is coming out that we don't know about it. But that's my opinion, and that will be one of those third level trader type takes. But we'll see. All right, historically, right? In February, I think around February 15th, we showed it. Bank of America put out a report they called it a primer, I think. Gold trading mini primer. And we were kind of gushing about this report, not because of the content. Most of the content is, it's nothing new for us. Maybe new for you guys, and that's great. It's very good. But this is the kind of report you put out when your clients are asking for a deeper understanding on gold. And so if you have $1 trillion in money under management in the equity side, and your equity guys say, you know what, we need to learn a little more at gold, they do this. And in doing this, embedded in it, they basically raised their target to 3,500 in a soft raise. We identified it, we pointed it out, and we sent it to everyone. The other thing they did in this report is they introduced the concept of, they touched on something that we had noticed. Actually, I saw first in social media. Bai Zhaojun shared it with me, friend of mine on the mainland, professional colleague. We don't hang out. He's in China. I'm in the US. But that was information that further showed China's commitment to basically de-dollarizing and monetizing gold as their risk factor. And then Eric Young, this King Kong, he understood it very quickly as well. And we've been going back and forth about it. If I do a whole thing on the insurance industry, I'll be sure to include Eric in that, in a conversation, because people aren't talking about it enough yet, but they should. Okay, so that's what this report did. It said, here's what gold is. Here's why we think it could go to 3,500. And that reason was based on the entry of Chinese insurance companies. Now, in that post, we put this. Where is that? Oh, here it is. We put a word about reading Bank of America's layout. We're going to replicate this as we go through their report. Okay, so you can refer back to it if you want to, but that's how you read, that's how you perceive a Bank of America report in terms of its formatting. Here's the founders version of it. We sent the PDF to founders, and here's the report we sent out yesterday. And as it says there, we are in the process of doing the HeartNet style video walkthrough now. Okay, we're going to use the PDF for that. What are you looking at? You're looking at a report that uses the first page as an executive summary. They just don't label it that way. So the first page of all their good reports is an executive summary. And then everything after it, no matter how convoluted the titles are, no matter how incongruous the titles are, no matter how not connected, whatever the titles are, they support this. Okay, so let's go through it. This report is entitled Gold-plating guns and cannons. Okay, well, first of all, there's no gold plating mentioned. There's no guns mentioned. There's no cannons mentioned. The title is very HeartNet-esque in that what they're saying is there's tariffs and trade wars, and wars are guns and cannons, and gold plating is, all your guns and cannons have gold plating. All right, there are 3 paragraphs here. Luckily, we had to read this twice to really figure out the layout. All right, so here we go. First paragraph. This paragraph formalizes their call for 3,500. And then it tells you the 3 demand cohorts that they've quantified better than anyone else. Most haven't done it at all, except for Goldman. They've quantified why the demand will increase. And then they also touch on the uncertainties that could raise the price, although they don't say it, or lower the price. Let's do that paragraph first. Having hit our long-term price target of $3,000 per ounce, we believe gold could rally to $3,500 if investment demand increases by 10%. Spoiler alert, investment demand is going to increase by 10% based on their own math. So we make this our new price forecast. So that's the way of backing into their target. Where could demand come from? There you go. So here's the 3 categories or cohorts of demand. China insurance industry, central bank buying, and retail investors. That's it. So if they were to make a bulleted version of this, it would be gold goes to 3,500 if demand increases by 10%. Demand will increase by 10% because we believe these 3 categories, China's insurance industry, central bank buying, and retail investors, are going to drive it over 10%. And that's it. That's the paragraph. Now, they also give a nice 1-sentence summary of why each category is going to increase. So, for example, China's insurance industry can invest 1% of its assets in gold, equivalent to around 6% of the annual gold market. Central banks currently hold around 10% of the reserves in gold, which could raise this figure to 30%, right? That's category 2. And then 3 is retail investors have also been increasing. So the whole rest of the report, well, a big chunk of the rest of the report goes into this. It explains how the Chinese insurance industry money is going to be invested with charts and explanations, right? It explains why central banks have been buying and does something new, and that is they quantify publicly what their target is for central banks buying. Look, when you get into fundamental analysis at this level in a commodity, once you've established that there's a trend, in this case, let's be clear, they established it a year ago. We established it 2 years ago, right? They established it 2 years ago. They're just not sharing it until now. But once the trend of central bank buying can no longer be ignored, once it's been established, as a fundamental analyst, your goal is to then project any of 3 things. The destination, so think about it as a flight. Okay, we're in the air now. Where are we going? What's the quantity that they're going to buy, right? How fast will we get there, right? And what turbulence is ahead that can make this go faster or slower? And that's it, okay? So what they've chosen to do with regard to the central bank version is they said the destination is 30% of reserves. Now, the Goldman report likes to focus on the flight path. What is our angle in the air? how long will it take us to get there? But Bank of America is focusing on the destination. And they go in and make the case using basically efficient frontier hypothesis that central banks currently have 10% of their reserves in gold and could raise this figure to 30% to make their portfolios more efficient. Meaning, the way to risk their international risk is to have 30% of their reserves in gold. Period. Right now, it's only 10%. So they're going to buy 3 times the amount of gold they have now. Or they're going to buy 10% 2 more times. Okay? So assuming that prices are there. In the future. How long it takes, I don't know. But they're going to give you an answer. I think it's like 3 to 6 years, right? And that's a long flight path, right? When you're in the flight, you don't say, we're going to get there in 2 years. You say, we're going to get there in 3 years. And then you get people there early, and you say, we got there early. So they're being careful, right? Bank of America is very careful, even very careful with their targets, even when they're raising them, okay? They're similar to JP Morgan in this sense, but they're being, look, these reports are very frank. Okay, they're withholding, but they're withholding stuff that they really should not be putting out yet because they're not sure. But they're really sharing legitimate reasons to be long gold. It's almost like they know there's people like us out there, like policing them. I mean, I won't flatter us that much, but I know that Bank of America people read this. I know the Goldman people read our stuff. And I know that former Credit Suisse analysts have read it in the past. We don't know what they're doing now, though. All right, so anyway, finally, retail investors have also been increasing their exposure to gold with assets under management at physically backed ETFs increasing 4% year to date. So basically, the 3 sources of new demand are insurance companies out of China, central banks who have been buying, and they project will continue buying at a similar or the same pace, again, as does Goldman for different reasons, right? And finally, retail investors are back. That's it. Now, the next thing is, it says uncertainty. Uncertainty around Trump administration trade policies could continue to push the US dollar lower, further supporting gold prices near term. All right. This is something that could give a kicker, right? So the trade policies are already factoring in, but the trade policies themselves, meaning they're factored in a sense that, well, if you're going to use tariffs, I'm going to buy more gold, right? But if his trade policies kick in into a little bit hyperdrive, you're going to see the US dollar go lower. And if the US dollar goes lower, that's going to be bullish for gold, okay? In our view, a broad rebalancing of America's twin deficits could be bullish gold too, right? So basically, a rebalancing of America's twin deficits could be bullish gold. It could be bearish gold. We'll get into that in a second. I think that's in the second paragraph. Okay. In the second paragraph, by the way, most of the report goes through this. Okay. And then the rest of the report goes through these 2 paragraphs. All right. I'm going to read this and then I'll give you a take on it because it's pretty self-explanatory. There is no silver bullet to reduce U.S. twin budget and current account deficits. The U.S. has been running current account and government deficits for years, providing a steady supply of U.S. reserve assets, meaning issuing a lot of treasuries. A balanced U.S. current account may require lower capital inflows going forward. If this is accompanied by a shift from America first to America alone, that's a hard net phrase, central banks may further reduce U.S. dollar holdings, with gold being a beneficiary. Okay, let's stop right there and do this. The U.S. deficit that the world is now focusing on is big enough to make them de-dollarize. The cure for the U.S. deficit can also easily be bullish for gold, meaning how you cure the U.S. deficits is not a silver bullet for gold. It's not going to get the price of gold down, okay? Trump's approach is tariffs. There are many approaches to doing this. All of them are very difficult, and all of them necessitate taking pain. Trump is trying to raise tariffs, or at least threaten to raise tariffs with other countries. In doing that, that would be part of a multi-step cure for our current account and budget deficits. However, doing that only drives foreign holders of US Treasuries to sell them faster, to buy more. So the cure for US deficits as implemented by Trump potentially is bullish for gold because it's bearish for the dollar, because they'll stop buying US Treasuries and the dollar will weaken, and it's bearish for Treasuries as a store of value in general. So they're related, but they're not the same thing. Okay? So that's what he's saying here. The cure for the US budget deficit or twin deficits to get us on a more level playing field economically with the world is bearish the dollar, and therefore it's bullish gold. To sum this up, if you're a gold bug, the dollar's too high. And no matter what we do, whether it's tariffs, whether it's chickens and pots, the dollar has to go down relative to other countries' currencies. And that's bullish gold in dollar terms. You may see gold top out in these other currencies a couple of years from now and continue to go higher against the dollar for a decade. You could see that. Okay? So that's that whole point there. Now, the next part, right? Central banks, when you see the word, when you read a Bank of America report, when you see the word may, think the word as will. How much you don't know, but the word is will. Central banks will further reduce US dollar holdings, with gold being a beneficiary, as just said. This is all reason for central banks to buy more gold and to sell more dollars. In fixing the US deficit problem, the cure is a weaker dollar. Whether you weaken the dollar outright or whether you do other things that make other people weaken the dollar, that's what has to happen. And believe it or not, that's what we want. Now, there is a conventional wisdom out there to which we're a part of, we agree with. Tariffs usually lead to a stronger dollar, but they're not right now. How to counteract that? The US could put pressure on its partners to increase spending. So, when the US pulls out of NATO or reduces its defense footprint in Europe, Germany responds by saying, all right, I guess we'll spend more on defense. I guess we'll build our own infrastructure. And all of this puts pressure on the dollar. So tariffs make people own more dollars to do trade with US, but the US does other things. This is why what Trump's doing is kind of a chess game, to make them spend more. Okay? The dollar is going to be stronger if we raise tariffs, because you're going to have to own more dollars to do business. But guess what? Time to take the training wheels off, build your own economy up. Now, that's not because we love them. That's because the world is turning more mercantilist. And a mercantilist world says that you can't have a current account deficit. It's an accounting measure. You can't have a trade deficit if you're going to make money as a country. The current account is wiped out. There's no more current account. There's no more, what's the word I'm looking for? There's no more foreign investment to offset your spending. You've got to be self-sufficient in all things, financially as well as supply chain and economically. And so the US is kind of throwing it back to them. Here we go. As such, the euro indeed strengthened after Germany and the EU announced an increase in infrastructure and defense outlays. Subsidizing US exceptionalism and a weaker US dollar will likely remain bullish for gold. Okay, this sentence here, US exceptionalism is in part because of the stronger dollar. Okay, so European money, Japan money, all money is going to be leaving the US. And in leaving the US, American exceptionalism will drop because less dollars will be held. A weaker dollar will likely remain bullish. So all this, how we're curing, I'm going to give it to you in summary, how we're curing the trade deficit is bullish for gold. Sentiment drop. This is an interesting paragraph because we've actually been reading about this. And we want to spend a little time on it. So when you're with your family at Easter or Passover or whatever the next get-together is, You get to tell them Mar-a-Lago ain't happening. Put a cap on that shit. It's done. Okay. The Mar-a-Lago Accord is basically dressed down here. This paragraph says the Mar-a-Lago Accord is not happening. Now, I don't know why they put it in there, but they put it in there, and it seems like they're pushing back against someone that must have addressed it to them privately. We don't know who. All right. Quickly, as a background, the Mar-a-Lago Accord, which has now entered almost the mainstream media in discussion, is an idea put out by, I think his name is Stephen Moran. I'm not trying to say his last name, Miran. Stephen is a commerce secretary for under the Trump administration now. He's at a high level of importance. Now, he wrote up a paper, which we read and we published on Goldfix, describing a Mar-a-Lago Accord. Mar-a-Lago because it's based on Trump's hotel. And the Mar-a-Lago Accord is a multi-pronged plan to weaken the U.S. dollar in cooperation with other countries. That's what it is, simply, right? Multi-pronged, different ways to do it. Now, the reason it's an accord is because the Plaza Hotel Accord, 1985, the Smithsonian Accord, which was right after the Bretton Woods. These accords come up from time to time when the dollar is too strong as a global currency. And a strong dollar or too strong of a dollar is very bad for everyone. And we've been doing just fine, but it's very bad for everyone else. It will be very bad for us in a mercantilist, manufacturing economy. So we need a weaker dollar so we can export. They need a weaker dollar so their economies can grow. I'm sorry. Yeah, so their currencies can be stronger. The world needs to hit a different equilibrium level. And so from time to time, when your partner countries like the G7 say, they cry uncle, the dollar's too strong, we can't export any goods to you, you need to weaken the dollar, they get together and they have a plan and they smoke their cigars and they figure it out. Now, this destroys in 3 sentences why the Mar-a-Lago Accord is not going to happen and is borderline stupid. I'm going to call that what it is because that's what they're implying. Now, before I do that, there's a video that I have saved of Stephen Moran 2 days ago coming out in public and officially saying the Mar-a-Lago Accord is not going to happen. We're going with the tariff route. Now, I don't know. I'm not familiar with his speaking, but he seemed like a guy who really was there to get a message out. It's not happening. Put a fork in it. It's done. He wasn't there to say, we're working on it. He was there to say, yeah, it could come back. But as of right now, it's done. So when your family is saying Mar-a-Lago Accord, understand that they know about it because it has Trump's hotel in the name, and the mainstream media picked it up, and the mainstream media is talking about it, but they don't know what they're talking about, okay? Fortunately, Bank of America does. Fortunately, we do. Fortunately, we read the report. And by the way, that report, the Mar-a-Lago Accord concept, actually wanted the U.S. to sell gold, okay? That report said, I'm going to tell you this because it's important. That report said, number one, we're going to weaken the dollar in coordination with our trade partners. We're going to come to an accord, number one. Number two, we're going to get our trade partners to roll their treasuries out from 10 or 20 or 30 years out to 100 years, right? Number three, we're going to keep inflation in check. And number four, we're going to sell gold. All those things, okay? Now, when you put all those things together, and I say this genuinely, when you put all those things together, what you're really doing is you're saying we're going to destroy inflation. We're going to keep inflation down by weakening the dollar, but we still want everyone to own the dollar. You're kind of saying the dollar will remain the global reserve currency because we want you to buy 100-year bonds and really put your investment into us. uh, but we're going to let inflation happen. So put it this way. If you're trying to decrease your currency strength, it's not necessarily inflationary, but this solution is inflationary. And in fact, it actually would say to the people that are being asked to do it that we're not solvent. It's really a bad plan. Now, I'm not going to say that I know it's a bad plan. I'm going to look at it and say there are pieces of this that don't line up. It's like we're going to eat our cake and have it too, or have your cake and eat it too, however you're supposed to say it. Anyway, so now you know. It's not, if it happens, it's very inflationary. Okay, so here we go. Let's read them tearing it apart. Could a Mar-a-Lago Accord help rebalance U.S. trade? We doubt that the accord will fly. In contrast to the Plaza Accord, not all U.S. trade partners are allies, making it less likely they will help out. See, the Plaza Accord was people that wanted to sell us things. They wanted us to weaken the dollar so they could export more BMWs to us. This accord, well, at that time, China was what, 12th economy in the world? Who knows? Could have been like the 50th economy in the world. Now China's number 2. China's not going to have any accord with us. Even if they do want a weaker dollar, which they don't, China's not going to have an accord with us. China is remaining pegged to the dollar, forcing us to debase against gold while they rebase against gold. Anyway, so it's an accord. You have to have willing people at the table who want to work with you. It won't happen, number one. Number two, back to the text. The proposed Treasury maturity exemption is effectively a default through the back door. Yeah, that's right. So you have lent me money for 30 years, and I say to you, I'm good for it. I want you to put it out to 100 years. You run for the exits when you hear that. You say, I'm going to take my 30 years and put them into 6-month treasuries now because I don't want to have any part of you. You're asking people to throw their commitment to the U.S. out on the yield curve 100 years when they're thinking about pulling it out. It's completely contrarian. It's insane. Okay? It's insane. Now, there are ways you could effectively do that. And this is very Trumpish. You would do carve-outs, like I'll give you higher rates. You basically create a situation where the people buying the treasury start having individual negotiations, and that's not good. We did that in the past with the Saudis, but that was a tit-for-tat trade. You buy our treasuries, we'll buy your oil, you price your oil in dollars, we'll give you an extra little bit of whipped cream on top of whatever your rate is. All right. So let's read his take on that. It also risks treating foreign treasury holders differently, another potential source of bond market stress. Yeah. See, you can't do that. You can do it, but you can't do that in a world where people know about it now. Okay? So Mar-a-Lago from here to here, no. Now within the Mar-a-Lago report or white paper, it's not an accord, it's a white paper, it's an idea. There was a threat of removing the security umbrella. Now I forget the phrasing on that, but the concept basically was this. If you don't do these things, we won't defend you. Kind of like with a threat to stop being the policeman. And that idea looks less of an issue now that Europe is already aiming to outpace U.S. spending in NATO. Right? Germany basically just said, fuck you. We'll raise our deficits and we'll outspend you in defending ourselves. We don't need your security umbrella. So it's the militarization of Europe again. Okay. So this whole report, according to Bank of America, putting it more demurely than I have, says, no, it doesn't work for major obvious reasons. And it's being talked about because it has Trump's hotel in it, which, by the way, the whole concept, although it's certainly, look, these are ideas that have been, discussed before, never put together in one paper. And the reason you know about it, if you know about it, is because Mar-a-Lago is the title of the report, which by the name, by the way, the name, the Mar-a-Lago Accord was actually created by James Rickards years ago in one of his books. And it wasn't this plan, but it was a catchy name. It was like during Trump's first administration, the Mar-a-Lago Accord. Maybe there'll be an accord for this or something like that. So that guy just basically took the name and put something else on it because it's a great name. And I would note that without even a citation. Different plan altogether, but same name. Anyway, trademark. I think Coca-Cola would not be happy if you took the name and said, we're going to do the Coca-Cola Accord. Anyway, they move on and they say, either way, tariffs and the risk of trade wars have affected U.S. sentiment. Look, if you're doing tariffs, you don't get an accord. It's either tariffs or an accord. Now, they may think that they're going to threaten tariffs and have them come to the table for an accord. But again, it doesn't happen without the big boy, and the big boy's China. What could put our country, okay, so here's the last part. What could make them wrong? We think U.S. fiscal consolidation, reduced geopolitical tensions, and a return to a collaborative intergovernmental relations, including more targeted tariffs on 2nd of April, are key risks. All right. So I have been boiling down what could make gold go down into two simple categories. Everything else is a derivative or a manifestation of it. Gold is being bought for domestic and international reasons. So let's start with the domestic. If the U.S. has a fiscal consolidation, then gold goes down. If the budget deficit is reduced without pain, I mean, I'm not saying it can't happen, but the miracle of the deficit is no longer here. Poof, it's gone. That makes gold go down, right? But in order to get gold go down, practically you have to weaken the dollar. But U.S. fiscal consolidation, a return to more fiscal, responsibly managed government without causing a major recession or a weaker dollar, makes gold drop. Period. End of story. Likelihood of that, small. Path of that happening, very probable. The question is, does it start this year or 5 years from now? That's the question, right? Okay. The second is international, and that's manifesting in geopolitical tensions. They don't trust us, right? So if domestically we have a fiscal problem, a spending problem, and internationally we have a trust problem, well, if they were to trust us again, then they would sell their gold out and buy treasuries, simplifying it, right? So if Trump were to have a negotiation with Putin and Putin said, yeah, we'll stop, you let us pump oil and we'll buy treasuries, that's a big deal. Whether they honor it or not is really not important in the short term. Having that conversation and having that discussion would probably make gold drop precipitously, at least in the short term. So a return to an international global trust between the two halves of the world, the BRICS and the G7, or the US and China, or the US and Russia, makes gold drop. Now, do I think that it would happen? Do I think that would make gold drop? I think it would make gold drop. Why? Well, they're not going to stop buying gold. They're going to keep buying gold, but central banks are going to pull their bid back. Then maybe they'll lower their bid by $500. Maybe they'll say, okay, the nuclear destruction clock is moved back 5 minutes. We'll lower our bid by $500. Okay. And on top of that, speculative players, which there's plenty of them, macro discretionary, will say, oh shit, if they're not going to buy more gold tomorrow, then they're going to buy more gold later. Then let's sell our gold out and let's see what happens. Okay. Gold goes down. Now, that's my opinion. Bank of America does not seem to think it's a big deal, although it is a big deal. They just don't say it's a big price deal. Goldman Sachs, different report, says no change at all. It's pretty aggressive. Anyway, maybe they're pulling our leg. I don't know. So there you go. Domestically, we get our budgets in order. Internationally, Putin and Trump hug it out. The rest of the report is an explanation of that front page. And I spent an inordinate amount of time on the front page. I'm not going to walk through this whole report, only because I basically just walked through the whole report in a cursory way. So you can enjoy this and read it. The titles, Bank of America tends to use subtitles, and the subtitles aren't necessarily a new idea or like this is a new idea we're going to talk about. They basically make declarative statements and then support them. We remain constructive gold. Here's why. Okay? We think gold investment is going to go up by 10%. Here's why. And by the way, so going back to this paragraph here, remember, we think gold's going to 3,500, and here are the three buyers that are going to make it happen. All right. Here's gold going to 3,500. Here's the 10% scenario. There's the bottom line of that. This whole page here is on the insurance companies. This is the central bank section. Central banks are going to buy more, not less, or buy more and for longer. That's actually long. And they show lots of graphics here of proof of it. We're still in the whole central bank thing. See, there's a lot of work in here because this is a new concept they're introducing. This is an efficient market frontier. Basically, not enough gold, too much gold, not doing anything. You want to be in this curve right here. This part of the curve, that's your efficient market frontier. And if you're in that part of the curve, you're getting the most bang for your buck in your gold use. And they think it's I think they're actually above 30%. Looks like they're like 30 to 35%. But anyway, that's what they think the target is. They have all these other graphs there, and they explain the whole thing. That's it, right? So this whole section here is central bank buying, why it's going to 30%. It's almost like an advice column. You should go to 30%, and here's why. And they think the central banks are going to do that. China is obviously one of the bigger ones.
Well, thanks for watching this morning's Markets and Metals with Vince Lanci. Sure hope you enjoyed the show. Thanks for being here. Although before we wrap up, there was one thing I had to let you know, and here is the silver chopper Ben Bernanke.
That is so cool.
Can you even see his tie flying in the wind while he throws out $100 bills?
Look at him getting ready to throw that money out there.
I see that.
Because that's what it looks like when
That
Ben
even looks
Bernanke-
like his sorry ass.
Look at the size of the bald silvery head.
Yeah.
It's enormous. Back propellers spin too.
How many ounces is that?
That's 26 ounces of 3/9 fine silver, homie.
As you can see here, some of the key features with your Silver Chopper Ben figurine, you can really get the control panel. Look, there's a whole dashboard for Ben to fly.
He wants to fly onto your desk and throw $100
Here,
bills
Ben.
out. Look at the precision.
I see that.
Greasy old bastard.
He's got 2 sets of spinnable propellers,
This
Bill.
thing's great.
Dude, you could fly that thing.
Wow. I could.
Look how happy he is. I think he's actually going to get out there and throw the $100 bills.
Jerome, no!
There'll be $1,000 bills by then.
I got this.
I like it.
Get the history before it's made.
Just click the link below to get your Silver Chopper Ben now. So yes, if you have always dreamed of having a silver minted helicopter Ben Bernanke flying into your kitchen and throwing $100 bills all across your home, well, now is your chance to get your very own Silver Chopper Ben with multiple spinning propellers and Ben's familiar brand of easy money love. We'll also toss in the Got Silver coffee mug. And you can find out more about that by clicking on the link below. But yes, we did mint Ben Bernanke in silver helicopter form. That's 26 ounces of 3/9 fine silver. And to get yours now, click on the link in the description field below. And with that said, we will see you again tomorrow.